I'm very worried that companies now are going to say, I'm not getting the returns on AI right now, but I can see it coming, and so I'm going to stop hiring young people now.
How blind has the US Federal Reserve been to what's going on in the economy right now, given the government shutdown and its impact on official statistics?
Yeah, so it's definitely had a problem of not having the most important data, the employment reports, and so we last had that in August, and that's what they tend to make policy, and so they're 2 months in now without having that. They try to build in other sources, so there's private sector data that they can use, but you don't really have the timeline and the history with that, and so they can see it, but they don't really know whether it's telling them as accurate a picture as they normally would get. And so it's really important that the government does reopen so that they can make, when they start to make these decisions, they actually know what they're doing.
The US Senate has taken a step closer towards reopening the government, which could mean we'll have US jobs data by the end of the week. What do you think it would show?
Yeah, so we're going to get the jobs data for September because that was all calculated. We won't ever get all of the jobs data for October, though, because some of it comes from companies and that data is saved, but some of it the government had to be actually calling people to get, and that didn't happen, and so the October picture is going to be gone. I think the September data is going to be okay, and so the U.S. economy is growing, not super strong, but it's going to be okay, and so it's probably going to be, maybe 50,000 jobs or so would be my estimate for what it's going to be.
But it's not going to be a true picture of what's going on in the jobs market.
It's going to be old because we're going to get the numbers for September, and we're here in November. And we just didn't collect the data in October, and so they are still going to be driving in the fog when they make their decision in December.
And so when the official data does catch up, once the government has reopened, what do you think it will show? Is it going to reflect the Doge layoffs, for instance, and possibly tariff-linked job losses?
The job growth is slowing, but we haven't seen any signs that it's broken down. And the data that we can really look to is the states are still giving us unemployment insurance. And so when someone loses their job, they then go and start to get money from the states. And that hasn't picked up yet. And so if something really bad had happened, we would have seen that. And so we're still going in this state where job market is weak, but we don't have that huge break yet. And the government workers, as part of this deal, the ones that were laid off, the Democrats insisted that they get rehired, and so the ones that were laid off in October are going to go back on the rolls, which is good.
Do you have concerns that the jobs market will weaken further, perhaps in relation to the incredible take-up of artificial intelligence?
Yeah, I mean, I think there's a lot of concerns, and so one is, we put a tax on the economy, tariffs, that slowed down job creation. We're very close to having no new jobs created. And if you roll the economy into recession, it takes you like 4 years to recover. And so that has to be foremost at the front of the Fed's mind. The second thing is what you mentioned on artificial intelligence. And what I think we're seeing is companies that I talked to in the last 6 months are dramatically seeing better results. And when they hire a new worker, it often takes a year or two before they get value from that worker. There's a lot of training. And so companies invest in young people, and then after a couple of years, they start to get returns. And I'm very worried that companies now are going to say, I'm not getting the returns on AI right now, but I can see it coming, and so I'm going to stop hiring young people now. And we can see the unemployment rate going up for recent college graduates. And so it looks like before we get the good part of AI, we might get the bad part first, which is less hiring.
And so how concerned are you that against that backdrop of a slowing jobs market, that inflation appears to be rising?
Yeah, so I'm less concerned about inflation than most people.
Why is that?
And so I think about, there are kind of three real components to inflation, and one of them is just how much wages are going up. And so the biggest cost to any firm is its employees. And when wages are going up a lot, then the company has to protect its profit margins by raising prices. We don't see that happening right now. The second thing is rental costs, and I know people in Australia are familiar with high rental costs. And in the U.S., they're actually falling right now. And so they went up a lot, but now apartment rents are falling about 1% a year. And so the part of inflation that is measured for rent is actually softening a little. And then third, in the U.S., we're very dominant on gasoline prices. And the official U.S. government forecast is for those prices to fall about 20% in the quarter ahead because there's enough oil on the market right now. And so we might have an inflation problem a year down the road, but in the next 6 months, it's probably going to head a little bit lower.
You haven't mentioned tariffs.
Yeah.
Tariff-linked inflation. You're not concerned about that?
I'm not concerned about that.
Why not?
And so because a tariff is a tax, and when people have to pay them, they end up having less money in their pockets. And when you have less money in your pockets, then if you pay more for the tariff good, you end up doing less of something else. And so you might buy a car and have to pay the tariff on it, but then you might not go on vacation. And so when you end up doing a tax, it's very rare that you get higher inflation permanently. You might get a one-time price increase.
What about if Trump's suggested $2,000 tariff check goes through and every American gets $2,000?
Yes, that's the type of thing that then can start to get inflation. And so I would probably be more worried about inflation if they were taking the tariff revenue and flipping it around and turning it into a big tax cut. And so just to give you a number, so to give everyone in America a $2,000 tax cut would cost about $700 billion, and the tariffs are raising about $300 billion. And so if you literally did that, there would be a much higher chance that you would get inflation going.
What about the big beautiful tax bill?
Yeah.
Is that a risk to inflation?
It's a smaller risk. You do have about $100 billion of tax cuts coming in March and April, and so growth should accelerate. And it's very small though. If we think about that extra $100 billion, the amount of spending the U.S. government did to get inflation really going after COVID was $6 trillion. And so it's just not of the same magnitude. A lot of the one big beautiful bill is just keeping tax cuts that are already in the economy in place. And so the numbers that are new tax cuts are much smaller than people realize.
And so what are the implications for the Fed funds rate? Where do you think it is going, and what do you think the Federal Reserve should do come December?
I think the Fed should cut because I'm less worried about inflation. And I think that we have weak jobs. We can see the unemployment rate has gone up for 2 straight years, very gradually. Tells me that we're too tight. So I think the Fed does one more cut. I don't know if it's going to be December. They've gotten pretty hawkish. And then they wait for the new chair. And in May, Chairman Jay Powell is going to get replaced by someone that President Trump picks. The president has expressed a very strong view that interest rates should be lower. And so I'd expect that the new chair will probably be lowering rates by another 50 basis points, another half of a percentage point once they come into office.
It has been reported that you are on the short list for that position. Have you had an interview with the Treasury Secretary?
I did, and so I was, I'm one of the 10 candidates that they've been interviewing. I interviewed about maybe 4 weeks ago, had a lovely 2-hour interview with the Treasury Secretary, and it covered everything. It covered every aspect of the Fed's tools. It probably covered 30 years of global macro history. We even got into a long discussion about the Bank of New Zealand for some reason. And the Treasury Secretary is a former global macro investor, and so it was very wide-ranging. I had a good time.
When do you expect the decision to be announced?
So the Treasury Secretary said that of the 11 candidates, he's going to send 3 or 4 names to President Trump after Thanksgiving. And then President Trump will interview those candidates during December. And so I would expect sometime between mid-December to mid-January that the new Fed chair would be announced. And so I think the plan is maybe January, but sometimes President Trump, once he makes the decision, likes to make it public, and so it might come sooner than we think once the interviews start with him.
President Trump hasn't been shy about his view that there should be more interest rate cuts. Do you think that he and you are on the same page?
I mean, so I was the first person to come out in August and say that the Fed should do a 50 basis point cut, which was fairly aggressive. And for me, what I look to the market, and the structure of the market tells me that you can lower short end rates another 25 basis points without making long-term rates go up. And the point that I would make is if you lower short-term rates so much that long-term rates go up, then that's going to make the housing economy, which is in recession in the U.S., even weaker. And so in the U.S., the problem is long-term rates, not short-term rates. And so I would just make my case that I'm working on making sure long-term rates are low, and I would be doing the best on that.
We've seen asset classes, various asset classes, resetting record highs all year. Are we in bubble territory now? Would another interest rate cut further that bubble?
That is actually the much bigger risk, and that is a fantastic question. And so it's not really inflation, but it's whether we're going to fuel another big asset bubble like we had around the internet and we had around housing. And so what we can see so far, so valuations are very high. When a bubble gets to be a real concern is when there's a lot of debt or credit attached to it. And in both the previous bubbles in the U.S., we could see corporate debt skyrocket, and then we could see household debt around mortgages skyrocket. Neither of that has happened yet. And so if we're in a bubble, we're still in the beginnings rather than the ends. But the Fed has to, that's the hard part of the job, is you can't roll the economy into recession and you can't inflate the next bubble. And that is the main decision the Fed chair has to make.
You did say yet. Do you think we are in the beginning of a bubble?
I think we are in the beginning of a bubble forming. Valuations are high, and it looks like some of the credit decisions are starting to take hold in September, but we're in the very early stages, and so it's a small one at the moment, and that's going to be the challenge for the Fed.
If an asset bubble turns into a credit bubble, where would you expect to see it first?
So you'll see it in the actual the debt numbers that the government collects, and so we have something called the flow of funds from the Federal Reserve, and it's the balance sheet for the whole country. So just like the way a person or a company has a balance sheet, they create it for the entire country, and we could see both bubbles forming in that data. Almost no one looks at it because it's very slow to come out. But we'll know when it's taking place. Looking backwards, it hasn't happened. Looking ahead, the ingredients are there.
How vulnerable would the share markets be to a 20% drop?
So 20% drop in equities is the level that could start to make you roll over into recession. Something that's very interesting about President Trump, which we can observe, is he doesn't really change policy when the market falls 10%. It's fallen twice to 20% under his 5 years of being president, and in both cases, he changed policy that was more accommodative to the market. And so there is a reaction function that we see when the market drops significant amount that he will change.
Just one final question. I'd love your take on the extremely large circular financing deals we're seeing in artificial intelligence. Clearly we've touched on what's going on in markets, but that specific aspect of what we're seeing in markets right now.
That's the reason why I think we're starting a bubble right now. Like before we saw that, everything in AI had been funded out of cash flow, which makes it less worry from a central bank standpoint. That was one of the signs during the technology bubble where we saw companies starting to do vendor finance, where the company is lending money to their customer because the customer doesn't have the money to buy it from you. And that's not the way we like to see things. And in September is where these giant circular deals happen, and the companies are pledging money that they don't have. And so we know that that's going to have to be done with debt, probably in private markets. And that's the start the point that it starts to be concerning. And so I'm not a fan of these circular deals because it is taking it from something that wasn't dangerous to something that is more dangerous.
Marc Sumerlin, thank you.
Thank you so much.